Now, stocks represent ownership. Common stocks can be classified as either growth or income stocks depending on the amount of dividends paid to the stockholder. Now, these dividends can be regular, such as quarterly or yearly. Extra dividends can be paid out. Generally, dividends are cash, but other benefits might be used, such as property. Now, here's a visual representation of we'll call this a preferred stock / income / growth stock. So this green line here represents the par value. Now, if this was a preferred stock, the par value here would equal the par value in the future. Because all the dividends are paid out to a preferred holder, they don't have the appreciative value. Now, let's say that we pay a substantial amount of dividends out, but we do retain some for growth. We will have some appreciative value here. So we refer to this is the growth of the stock. But since it's paying so much here in dividends, we refer to it as an income stock because the investor receives little growth but lots of income. Now, we could see it do this. Maybe we retain more of the income or retained earnings for higher growth, but if we have higher growth, we're going to pay little to maybe even zero dividends out. So we will consider this a growth stock. Now let's go ahead and look at this same growth perspective using actual numbers. Now let's say that Parker Incorporated is paying all of its earnings in dividends. So every quarter of the 4 quarters per year, it pays $1 per quarter. Therefore, it's paying $4 total per year. Now let's say that from the investor standpoint, we've determined the value or the risk reward is 10%. So if we require at least a 10% return and we're receiving $4, we'll divide the 10 into 4 and we'll get $40. It's a simple calculation for zero growth, or you can look at it this way. How much would you purchase this asset for if you require $4 each year or at least a 10% return? Well, it'd be $40 because $4 represents a 10% return on a $40 investment. Now, let's say this was a preferred stock or a zero growth stock, and let's say now that the firm is going to try to retain some to grow it. So here is how we determine the growth rate. We find the ROE, or the return on equity, and we multiply that by the retained rate. So before, the current payout rate was 0%, and they were retaining all 100%, or all to pay the $4. So now they say, let's go ahead and see if we can keep $1 of that. So we're going to retain $1 of the $4. So our retention rate is 25%, and our payout rate is the $3 on the $4, which is only 75%. So here's our decision. Our decision is to retain the 25% or $1 and invest into a project with a 12% return. We've determined this internally. So this is how we calculate growth. The growth rate is ROE times your retained rate, the firm's retained rate. So growth rate is 12%, retained rate is 25%. Therefore, we'll have a growth rate of 3%. So now if we have a growth rate of 3%, basically what we're trying to say is that we're going to retain some of that to grow that stock from its current $40 position. And in this case, if you take a look at this, we are still paying $3 out, right here, $3. But now we have an RS, or return of 10%. We minus the 3%, which is the simple dividend cash flow model, and we've driven the price up to $46.86. So we have some growth potential here. We wouldn't have that if we didn't retain some of it. Now, just for the fun of it, let's look at a second decision. And of course, if this number was 12% was higher, or we retain more, of course, we're going to grow more. Let's look at a poor decision. Decision number 2. We're going to retain 25%, but now look at the return. The return is 8%. And if you see, the investor requires 10%, and 8% just won't cut it. So if I do the math again here, you can see now the stock prices actually went down. So it's really important for your internal managers to understand what the risk of owning the stock is, because what the investor will do is, if I need at least a 10% and you're only getting me 8%, the market's going to say, well, it's just not worth the reward. That at that price, it's not worth it, so we're going to sell it down and drive the price down to about $37.50. So here's a mathematical representation of the difference between a zero growth stock and a, we'll call this a, you can call it a growth or an income stock, but the only way we can have some growth is we have to retain some. And the more we retain, in this case it wasn't a lot, we were only retaining 25%. So we're not going to grow the stock by much, but the more we retain, the higher retention rate, the higher growth potential. Also, that does affect this as well. The more we retain, the higher the risk of owning that stock is.